All right, we want to get you up to speed on another big story of the day, and that's job cuts. Amazon, Vimeo, Stitch Fix all announcing layoffs today. Amazon CEO Andy Jassy confirming plans to cut 18,000 employees across several teams, including HR and Amazon stores. Vimeo on that list, too, announcing another round of layoffs, this time cutting 11% of its workers. Now, in an email to the team, the CEO noting, quote, further deterioration in economic conditions. It has certainly been a tough start to the year, especially in tech, where we already started to see some of those job losses last year. That has carried over to this year. And just in the first couple of days, more than 25,000 jobs have been shed from the tech sector alone. And that's not all, because taking a look at Stitch Fix, which is more so retail consumer facing, they're letting go about 20% of their workforce today. Their CEO, Elizabeth Spaulding, is also going to be stepping down there. So an executive shakeup, companies really doing all they can in order to cut costs because of this potential recessionary environment that we are in, and people really changing how they're spending and how they're spending their time.
Interesting to see Amazon shares, as you showed, down at all, because investors cheer these layoffs, but down 1.5%. Usually they cheer layoffs, which tells you they're not nearly enough and not nearly a big enough picture for the Amazon story, which is largely an AWS story at this point. But I find that Stitch Fix probably the biggest news because it is non-tech related. We talk a lot about these tech layoffs. That is not going to do the trick. In terms of the Fed, we're not cheering layoffs, but the Fed certainly needs some. And you're talking about 10% of the GDP comes from the tech sector, but only about, 12 million roughly jobs in total in the tech sector. So if all of them were wiped out, it still wouldn't be what the Fed probably needs. Compass, the real estate giant, also laid off the third round of layoffs in the last year. Just about 450 layoffs, but they continue. They've gone from a $6 billion market cap to a $1 billion company. More bad news for the real estate sector. And the information reporting Twitter laid off 40 data scientists in terms of advertising.
Yeah, certainly a number of layoffs. We want to stick with that story and dive deeper into Amazon's plan to lay off 18,000 workers. For more on that, we want to bring in Nick Jones. He's JMP Securities Equity Research Analyst. Nick, it's great to see you. So let's talk about the impact here on Amazon, because yes, it's 18,000 jobs, but in the grand scheme of things, when you take into account Amazon has 1.5 million employees, it's a very small chunk. But how are you viewing these layoffs and what it could signal ahead?
Yeah, I mean, you're right. It's a very small chunk of their employment or their workforce. We view it as that they are starting to look at operating income. This is an area that investors are increasingly looking at. You want to see Amazon, give better guidance to these numbers as we progress through each quarter. So while, we don't think it's really going to move the needle materially, we like that they're focusing on this and they're making cuts, which should give investors some solace that they are paying attention. But as you mentioned earlier in the segment, the stock price isn't reacting, and clearly investors don't see this as, meaningful enough today.
Yeah, reacting, in fact, the opposite direction as we've become accustomed to, Nick. And it's good to see you. Are there more cuts coming to Amazon in terms of headcount or more cost cutting?
I mean, there could be. Upper funnel trends on retail don't look great. Advertising generally follows retail, so the advertising segment will likely follow. And as enterprises are thinking about making layoffs, then they're also going to think about making cloud investments, or maybe just delaying them until they have more macro clarity. So overall, there could be more to come, but we like Amazon investing in future technology. We like them investing in growth. So for us, we don't think it has to happen. We still like the stock as it, from here today. But there could be more to come as upper funnel trends continue to deteriorate.
Nick, what's the level in terms of the scale of the cuts that you would start to get concerned? Because right now you still have an outperform rating on the stock, $140 price target. Like what you're saying, you're not too concerned about the news we're getting today. But when does that start potentially affecting your investment thesis?
I think for us, it'd be more about their ability to control operating income and kind of say 1Q guidance or how they're talking about next year. I didn't think they really needed to do more cuts. Clearly, the trends are indicating that they think they may need to preserve the operating income investors are looking for. If more cuts come, I think that's more likely to be viewed as a positive by investors. That wouldn't concern us more. That probably, if anything, gets the stock moving higher from here. If operating income really starts to become a problem, the lack of cuts would be more concerning in the coming quarters.
Amazon dropped about half its market cap just last year. What's the catalyst to get things back on track? Is it still largely an AWS story?
Yes, it is. It's definitely still an AWS story. I mean, we still want to see retail work. I think advertising is underappreciated, but heading into a recession, it's hard to like advertising going into kind of 2023. So really, we need to see AWS start reaccelerating. We need to see retail kind of, estimates need to start increasing on the retail segment. We kind of need to bottom out in terms of estimates and get more visibility on the macro situation. Is the Fed going to continue to increase rates, and by how much? I think once we get some visibility into kind of cost of capital, where rates are going, that's when investors can kind of pick their head up and start thinking about what back half of 23 and 24 starts to look like.
And Nick, I know you cover a number of consumer-facing names: eBay, Etsy, Poshmark, all on your list here. What do you think the 2023 has in store here in terms of the significance of the slowdown and what it means for so many consumer-facing names?
Yeah, it's going to be a tough setup. Saving rates are declining. They're very low today, so that means discretionary income is going to start decreasing. Within my coverage, we think Etsy has been one of the best performers with their kind of robust platform, a lot of tech enhancements to keep people coming back and going to different segments. But overall, it's really going to be tied to personal consumption expenditure. E-com will continue to gain share, but if discretionary spend starts to decrease, there's going to be overall less spend on retail. That will impact e-com, even though they're back to share gains. So it could be a tough first half, we think, for e-commerce, but we think it's looking better kind of in the back half as we get over easier comps. All that said, we think Etsy's positioned as kind of the best e-commerce marketplace right now.
And to follow back up on Amazon, Andy Jassy could not have been handed this baton at a worse time. They have shed more than $1 trillion since he took over. Is he, despite all that, making the right moves? Do investors have confidence?
We think so. I think it's just very much, the theme I keep hearing talking to investors is you can't fight the Fed, you can't fight macro. I think this is very much a macro Fed-driven market, and that's really compressing multiples. We were looking today, most of the multiples of the stocks we cover are well below their 5 or 10-year average, in many cases below one standard deviation below that, meaning multiples have compressed materially, close to what recessionary levels looked like during the great financial crisis. So I think this is very much a macro dynamic, more so than anything idiosyncratic to what Jassy is doing at the company.
Indeed. All right, Nick Jones, JMP Securities. Good to see you, man. Thank you.